we're looking at how do we maximize our tax write-off when we travel, because oftentimes we're traveling for business to look at our, visit our properties. But while we're there, we might have, a little bit of time for personal enjoyment.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Thank you all for joining us on another episode of The Gentle Art of Crushing It. My name is Marta, and I'm your host. I am super stoked and excited for our two guests today. Their names are Amanda Han and Mac MacFarland, and they are tax gurus in the real estate space. So just as by way of introduction, real quick, Amanda Han and Mac MacFarland are CPAs and tax strategists who specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money. They help educate investors on how to maximize tax write-offs, legal entity strategies, tax-efficient ways to access profit, and how to use 401k money for real estate. They are authors of the highly rated book called Tax Strategies for the Savvy Real Estate Investor, and they have been featured on multiple prominent publications, including Forbes Finance Council, Money Magazine, Talks at Google, CNBC, Smart Money Talk Radio, and BiggerPockets. Amazing. So great to have you guys on. We'd love to dive in and really have you talk a little bit about how you got into this space and how you got to where you are with your business today.
Yeah, well, thanks for having us, Marta. I appreciate it. We're super excited to be here too. Yeah, I guess how we started, we both got started working in the accounting industry at a Big Four accounting firm, and that's where we met. We are actually married to each other for listeners' benefit, so this doesn't sound strange or whatever. But we both started working at Big Four. I was working in kind of I guess it was private client, a high net worth individual group. Working with wealthy individuals who had small businesses. And a lot of them had real estate, and that was kind of where I had my aha moment. I was reviewing the gentleman's tax return. He's probably in his 60s. He was retired. Looking at his tax return, it was clear he was making over $200,000 in cash flow and not paying any taxes. And this is 20 plus years ago, So as somebody in my I was early 20s, I was like, yeah, I get it now, And so I was kind of like to tailor what I was working on into real estate just because that's what I liked and understood. And yeah.
Awesome. And what about you, Amanda?
I have a little bit of a different story. Like Matt said, we both met at the same firm. I happened to be in the real estate group. So there was a lot of overlap in what we did, right? I worked on kind of the real estate investment companies, the developers, and those were my clients. And of course, the ultimate business owners were his clients on the individual side. And for me, I actually grew up, I'm the third generation of real estate investors in my family. So my grandparents invested quite a bit in real estate. My parents dabbled in real estate a little bit. And, but I was always taught to, get good grades, get a good job, and what safer job than being a CPA and doing accounting stuff. So yeah, I didn't really get into real estate until Matt started reading Rich Dad Poor Dad book and kind of, he told me, yeah, we got to buy some properties. And I really thought he had lost his mind when he said that because I'm like, I don't even know what you're talking about.
That's awesome. And so when did you guys start investing and what was that experience like?
Yeah, it's been over 15 years. I don't remember the exact year, but it was kind of, started, we had some properties on our own. We invested in other people's deals, and it's kind of followed that path all along. It's kind of, I guess our primary focus is building the business where we help real estate investors. So like being full-time investors ourselves is not, not on the table for us. So we do more passive investing in other people's deals and our own properties and things like that.
I think like a lot of our clients, there was a point in our lives where when we had stopped working full time at our job, and we thought, we're going to do real estate full time. We had a lot of clients who did syndications of apartments and things like that, and we thought, yeah, that's what we're gonna do. We're gonna do our own syndications, and we quickly realized that we were both fighting to not actually do that, like, looking for deals and negotiating deals, but we were really fighting to do more of the client service work and working with clients on the planning side. So that was kind of a good lesson for us, whereas I think for a lot of people, you might think, yeah, I really just want to do real estate full time. And maybe you come to the realization that that's just always better as a passive investment vehicle for you. And maybe you're passionate about something else. And I always tell people we're really blessed that we're able to kind of combine both, our two passions, which is real estate and tax planning, and be able to have our firm where we get to, work on both of those together. Yeah, I think it's interesting. I think for us, we actually see the opposite because by the time people call us, it's because they, have a friend or a colleague or have heard about how you can save massive amounts of taxes using real estate. And so they're like, yes, I definitely want to get into real estate kind of for all the tax benefits. But I think at the heart of it, when you hear about the tax code really favoring business owners, the greatest thing about that comment is real estate investors are business owners in the eyes of the IRS. And it doesn't mean like you have to have a legal entity or anything, but if you have rental income and you're a landlord, that is a business for tax purposes, which means now the doors are wide open in terms of, tax write-offs and deductions and just the ability to create more tax efficient income outside of just, W-2 or a business where you're paying a lot of taxes on that.
Yeah, I mean, a great example of that is, or comparison, I guess, is somebody goes out and buys, they choose to invest in stocks. So they buy the stocks. They're not writing off the cost of the stock right away. They don't actually get to write it off until they've sold it down the road, right? But with rental properties, for people who are investing, all know, kind of we call it the holy grail of investing in real estate is you get depreciation expense. So the IRS allows you to write off a part of your purchase price every year through depreciation because of like normal wear and tear. So the benefit of that is tax efficient income that Amanda's mentioning is you've got hopefully positive cash flow, but with enough depreciation expense, you may not even be paying taxes on that cash flow right now. So it's a tax efficient way of earning money, and it's basically kind of not tax free. You're going to pay taxes at some point, but it is definitely a great way to earn money in a tax efficient manner for sure.
Yeah, tax deferment, right?
Yeah.
Yeah, very cool. So cash flow is passive income, and for many listeners here, they have W-2 income. Can you talk a little bit about um, the tax advantage? Well, so the difference, right, between what you can or cannot deduct from passive versus W-2 income?
Yeah, that's a great question. It's actually a common misconception for many taxpayers is that regardless of whether you're active or passive, the deductions are actually exactly the same. So, if you are a rental investor and you're spending money on your rental properties, or you're claiming a home office, or maybe you went to a real estate conference to learn more about real estate, those are all expenses that offset rental income, regardless of whether you're active or passive in the real estate space. The only difference really between active and passive investors are times when you actually end up with a tax loss. So let's say I have my income, I write off all my expenses, and now I have this overall loss. with respect to my rental real estate, then the question becomes, when and how can I use that loss to offset my different types of income? And that's where that, passive and active comes into play in a difference.
Yeah, because in the tax world, the IRS kind of looks at like if it's something's passive, where you're not involved on a day-to-day basis, and rental properties are default passive. They say that generally you can't deduct a passive loss against other types of income,
like W-2.
W-2 or business income, interest dividends, that kind of thing.
Is that true?
Yeah, it is true for most people. If you make under $150,000, they do allow you to deduct up to $25,000 of rental losses against your income. But if somebody happens to make over 150 grand, single and married, then in order to deduct your rental losses against your other income, generally speaking, you or your spouse would have to qualify as a real estate professional, which in essence just converts your rental activities from passive to non-passive, and allows you to deduct losses against your W-2 income. So definitely something people can get to. It's just a planning opportunity that, if you put the right facts in order and get everything ducks in a row, then you definitely can qualify.
Yeah. Can you say a little bit more about the real estate professional status and what that even is?
Yeah. So real estate professional, contrary to popular belief, doesn't mean you have to be a realtor or a broker and start showing houses on the weekends. But it does have everything to do with where you spend your time and what you do with your time. So from the tax perspective, there's a couple major things to accomplish to reach real estate professional. The first one is you have to spend at least 750 hours in real estate. So that could be your time on your properties. It could be your time as a realtor or property manager. So at least 750 hours. And then the next thing you have to meet is you have to have spent more time in real estate than your jobs. So if you're someone who's not working another job, then it's easy. We have 750 hours. But if you're someone who's working a full-time job, that's typically about 2,000 hours a year, then it becomes very difficult, if not impossible, to qualify as a real estate professional, because now you need over 2,000 hours in real estate to qualify for a real estate professional. And then the third requirement is you have to meet material participation hours. And those just means, being hands-on, more actively involved in the day-to-day operations of being a landlord. So once somebody reaches those three hours requirements, then you're considered a real estate professional in the tax world. And the benefit, like Matt said, is then you're able to use rental losses not just to offset rental income, but also W-2 and other income sources. So this is where we see someone who's, either doing real estate more on a full-time basis, or you might have a taxpayer who, one person is a high income earner and then the other spouse is a real estate professional, and really being able to maximize the tax benefit of investing in real estate, offsetting that or the other spouse's W-2 income.
Ah, that's the secret ingredient there. Okay. I'm going to have to...
The secret sauce.
That's awesome. The great summary. And by the way, I have to tell you a quick story about your book. It was funny because I read the first volume of the 2 volumes, and my husband came in as I was reading your book, and he's like, what are you doing? I'm like, I'm reading a tax book, and it's really good. And he just looked at me with this puzzled look on his face, because he didn't understand, number one, why I was reading a tax book, and number two, why I was actually enjoying it. So I appreciate the way that you've written your book, because it just kind of gets across to the broader audience in terms of helping to understand some of those like tax nuances and how to deploy really some of these strategies around, the main thing that kind of sticks out in my mind is the sandwich method, right? Do you want to talk a little bit about the sandwich method?
Yeah, we can definitely do that. But I thank you so much for sharing that, because that's when we hear all the time when people will say, yeah, I was on the beach reading a tax book and my family's making fun of me, or, I couldn't put the book down and just people were, think I'm really weird. So we love hearing stories about that.
Yeah, we were actually at an event recently, and a conference at a hotel, and we were walking out of the elevator, and this lady's walking by us, and she does a double take. And she stops and holds up the book.
She was like,
and says,
"This is you.
This is you. I was reading this by the pool."
Yeah.
I was like, all right. It's just that's my venture into fame, I guess.
Yeah, and the weekend sandwich strategy is where when we're looking at how do we maximize our tax write-off when we travel, because oftentimes we're traveling for business to look at our visit our properties, look at the properties that where we might purchase in those places. But while we're there, we might have a little bit of time for personal enjoyment. So the trip itself doesn't have to be business 24/7. And so the concept is, if I'm traveling to a location where I have business activities that are pre-planned, right? Either already dealing with my properties or meeting with local realtors, investors, agents, and things like that. But how do I do it in a way that I can kind of squeeze in a little bit of fun? And so, an example might be if we're traveling on a Thursday, doing business on a Friday. Well, maybe we'll stay Saturday and Sunday. And if we could have some predetermined business activities on, let's say, the following Monday and or maybe even Tuesday, then we're sandwiching in that Saturday and Sunday, but we can have a little bit more fun while we're already there. Now, it's not to say that if we decide to go to Disney World those days, we can't really write off the tickets unless there's a clear business purpose. But it does help us to allow us to write off at least like the hotel and the rental cars in those days during the weekend. So that's the concept of just making sure we're intentional about what we do and how we plan out our trip and our investment so we can maximize our tax write-offs legitimately.
Very cool. Yeah, I love the way you explain that because it just makes so much more sense, and it's actually like actionable, right? You say it in a way that I can actually take that and now implement it. So I really appreciate that. Awesome. I'd love to hear you talk a little bit about legal entities and how you think about setting up legal entities. For example, when you have, one investment, multiple investments, and then you plug in maybe another business underneath that. Can you talk a little bit about the legal entities that you would implement to essentially leverage as a way to, maximize your tax deductions through those legal entities?
Yeah, it is definitely something that's a big part of holistic planning, right? Making sure you've got your asset protection set up, make sure you're doing it in such a way that it's tax efficient. Um, Now, for a lot of people, for rental properties at least, um, we usually talk to clients about utilizing LLCs to hold title to rental properties, but with the caveat that for rental properties specifically, there is actually no tax difference whether you own them personally or you own them through an LLC. Because the reason is, at the end of the day, it all gets reported in your personal tax return. So the amount of net income you report or how you report or what you pay taxes on, it's going to be the exact same. So for rental properties, the use of LLCs to hold title is generally an asset protection strategy. And so, we can talk to clients about kind of the pros and cons of that and things, but we're not attorneys. So we always recommend clients to talk to attorneys, their asset protection attorney. But for, other types of businesses, we have a lot of clients doing fix and flip, wholesale, realtors, property management. A lot of times for service businesses like that, we'll typically look like an S corporation or maybe even a C corporation in the right situation. Because there's ways that you can, take advantage of retirement account contributions and benefits, and also minimize self-employment taxes when you utilize corporations instead of just running it like a Schedule C on your personal tax return, something like that.
Gotcha. So you'd recommend putting that legal entity into place?
Yeah, again, in the right, not it's never one size fits all, but a lot of times for those service businesses, some sort of corporation makes sense, and then owning title to the real estate. Then whether you have one property, multiple properties, one LLC, multiple LLCs, that kind of comes down to almost like a risk tolerance perspective of the investor, also an annual cost because you're going to have setup fees, you're going to have annual maintenance fees, you may, depending on the state and type of entity, you may have tax return filing fees. So we always tell clients it's not one of those things where if you're in an event and somebody's saying run in the back of the room and form a bunch of entities because some super uber wealthy guy did that, then that doesn't mean you need to do it, you know?
Got it. Got it. So yeah, that makes sense. Makes sense. It also probably depends on the size of your portfolio, right? As well.
Yeah.
Sure.
Yeah.
So kind of curious to hear you talk a little bit about some of the common mistakes that you see when you work with clients around, tax mistakes that they make right off the bat when they're starting.
Since we're talking about legal entities, that's one that it's a common mistake we see for newer investors, kind of on both extremes, right? We have people who are really go-getters and just starting out, they buy about, a handful of properties in the first year, just all in personal names. And so, like Matt mentioned, make sure you talk to your attorney because there are, even though there's no tax difference of owning your rentals personally or in an LLC, there definitely are asset protection concerns. So you just want to make sure you have an attorney on your team to get it set up correctly. But we've also seen the other extreme where it's someone who just maybe even has one rental property or no rentals yet, but they've gone out and formed all these different entities in anticipation of doing XYZ transaction.
Still a go-getter in some way.
Yeah, but the issue is, of course, every entity comes with a cost. The legal fee of filing paperwork with the state every year, bookkeeping, getting tax returns filed, especially for people who are in, certain states like California, every entity comes with a very high cost. So I think just really important to make sure that you are working with your own advisor and figure out what is the right structuring for me before just going out and doing it. Like Matt said, because some famous person did it that way, or you saw it on, social media, that's what somebody is doing, right?
I think the thing that comes to my mind is, I guess a common mistake and, is just not with taxpayers, clients, investors, whoever, just not having that open line of communication with their tax advisor, their team of advisors. It's we tell clients that, we don't expect you to be a CPA, but we need to know what's going on in your life to help advise you, right? So, you waiting to tell us on April 1st about what happened the previous year, there's not a lot of options to help you at that point in time. We want to know what's going to happen before it happens. So if you're planning to sell a property, you're planning to buy a property, you're planning to invest in somebody else's deal, it can be as simple as just shooting an email to your advisor team and saying, hey, this is what I'm thinking about doing. Anything I should think about, consider, pros, cons. It doesn't have to be a long, drawn-out conversation, just something like that so that we or your team of advisors is on the same page and can, advise you ahead of time, obviously.
Yeah, great. Thank you. That's super helpful. In terms of your relationship with a CPA, like what do you guys typically recommend in terms of how often you get together with them, do planning around everything that's happening?
That's a great question. I think the answer to that really differs from taxpayer to taxpayer. And even for the same taxpayer, it could differ depending on the time of the year, too. So we have clients, if they're heavily involved in certain transactions, we might talk to them multiple times a week, right? Because there's things going on. They're trying to do a 1031 exchange, or they're trying to close on a property or getting a partnership set up with other investors. So that's a very frequent conversation that we want to be involved in. But then, maybe after that structure is done, and now we're just holding rental properties for cash flow, it could be months without needing any kind of conversation if everything is pretty status quo. So I think, so even for our clients, we don't have any like mandatory, must meet monthly or quarterly, because it's just really based on need. And so for the investor, or the investor and the client, what we tell them is, hey, just, always have taxes in the back of your mind, right? If you're doing something major, let us know. It could be a 2-sentence email, or it could be a 5-minute phone call. But from there is kind of when we're able to get a better idea on what are the opportunities or what are the pitfalls that we want to avoid in that transaction.
Got it. So to that point, I have a question for you, speaking of taxes. So right now, my husband and I are undergoing 2 house renos, one for a new home, one just finished up for a home that's being put on the market. Any tax tips or tricks there for like a deduction standpoint, or is that even something that we should be thinking about for next year?
Well, I appreciate you being honest and saying this is your story, because a lot of times we'll hear, hey, my friend is doing this.
You're right. This is the first time someone has
Right.
said,
Right. This
my
is
question is this.
Yes, this is the first time someone's come clean. Yeah, I mean, anytime anyone's doing renovations, I mean, no, I don't. Is this one of your rental properties? Is this your primary residence?
This is going to be a primary residence.
Um, yeah, I mean, anytime someone's doing renovation, whether it's primary or rental, you should definitely keep good records of all the costs you're spending. I mean, on a primary residence, you may be able to recoup some of those down the road when you sell it and to reduce your gain. If you're doing some sort of like, solar enhancements to the property, there may be some credits available. But especially on rental properties, on rental properties, there's going to be some things that people can deduct up front. There'll be some of those costs you got to spread out over time. So we just tell clients to keep as detailed a list as possible, much description as possible, and then we can help them come tax return time to evaluate that and maximize the deductions in the ways that are allowed by the IRS.
Yeah, so instead of saying, "Oh, I spent $30,000 on my rental kitchen remodel," you want to be able to have more details. So, I spend $10,000 on the flooring, 20,000 on the cabinets, and with that level of detail, then the tax preparer can help you to accelerate that write-off instead of saying, "Well, everything I have to write off over 27 and a half years," right? I can get some of that up front.
Yeah, wonderful. Well, I've got all that detail. I'm like the budgeting queen for 2 homes right now, so we're good to go with the receipts and the and the tallies. Awesome. So, speaking of deductions, you've given a few examples already, but any other ways that folks can maximize deductions on rental properties and new investments?
I mean, I think we talked about real estate professional, I mean, that and the requirements for that. And now that does have to do with people's when they're doing what we call long-term rentals, meaning they're renting it out for a year to somebody or 2 years or what have you. But, obviously, as Amanda mentioned, those requirements can be, it's a high threshold to get to, obviously, especially if someone's working at least a part-time job or even a full-time job. So we actually have clients doing the opposite, where they're investing instead of long-term rentals, they're investing in short-term rentals. So they're, think Vrbo, Airbnb, something like that, where they're renting out an average of 7 days or less for the year. Um, there are ways that makes it a lot easier when you're self-managing or your own short-term rentals. There's ways that you can take losses on those and deduct them against your W-2 income. And it's a lot, let's call it a lower threshold to meet than real estate professional. So we definitely have clients taking advantage of that because they can self-manage those and still work a full-time job, and and get to the point of still saving on taxes.
Gotcha. Yeah. I mean, the management of short-term rentals obviously is a lot more labor intense than long-term. So I could see that. Yeah, that would be easier. Yeah, there you go. One quicker strategy to writing off or deducting some W-2 income there. Awesome. Great. Um, well, so what's next? Tell us a little bit about your CPA firm. Are you accepting new clients, and how do you typically manage incoming clients, and what are some of the services that your firm provides?
So our firm, I mean, we specialize in working with real estate investors. We work with investors all the way from, newer investors, like people who just have a full-time job or running their business, but know that they want real estate to be one of their wealth building tools and really want to understand how to utilize that to reduce taxes, all the way to very advanced people who do real estate full time, running syndications and things like that. So the different service level really for us it is kind of depends on what the investor's needs are, and that's the reason we have a free consultation with our team to speak with prospective people who just kind of want to know, does it make sense for them to do tax planning. Although we do tax planning as well as tax return filing, I have to say the majority of people who come to us are first and foremost looking for tax planning, because that seems to be the service that's missing, I think, from most investors. I think everybody has a CPA who files their returns. But what we hear a lot is, my CPA doesn't do planning or doesn't understand real estate. And it works out well because that's what we're passionate about, is helping people with the planning side. Because one thing we always say is if you do the right things during the year, then there are a lot of opportunities to minimize taxes. But if you're only looking at last year's transactions when you're filing your tax returns, there's very few things that are legal ways to still reduce taxes.
So in other words, someone could come to you guys for the planning aspect and then take what they've learned there to their CPA. Is that right?
Yeah, we have people who do that, or we have people who just have us do both the planning and the tax filing. So yeah, it kind of depends on what the investor's needs are. We have clients who's like maybe had someone recently that their father-in-law is their, that prepares their tax return. So of course you can't fire your father-in-law. He's still going to file your taxes, but now you have the strategies and you did all the right things. So it's easier, right, for the father-in-law to just, put those numbers on paper.
Yeah, plug those numbers in. That's right. Very cool. So what's next? Any more books coming out? I really hope so, because they are really good.
You're trying to add to our work list.
Yeah. It's funny because somebody else asked us that. Actually, we were just speaking yesterday at an event in San Diego. They asked the same thing. We're not sure. We're always toying around with the idea of writing additional books. We had thought about maybe doing a short-term rental book because we have so many clients using the short-term rental loophole. So lots of great stories to share about that. Also maybe just like a general wealth building about tax. I know you're really big into mindset, and I think there's such a negative mindset for most people when it comes to taxes and just how we perceive it. So that might be something interesting that, we've been throwing around too.
And you guys are already on that path. You make taxes seem fun. So just keep going down that path.
And so the past 6 months, we've been doing a lot more stuff on social media, which is like a new thing for us. Accountants don't do much of social media stuff, but it's been fun for us. And, try to post just daily tax tips for investors has been challenging, but also, a good time for us to, like you said, right, make our content more engaging so that people can actually digest it and put it to practice.
Yeah, exactly. Little tips and tricks every day. And that'll kind of keep taxes on the forefront, I think, for people too, which is awesome. Cool. Well, how can folks get in touch with you? What's the best way to connect with the both of you?
Our website is the best place. We actually have a ton of great free resources on there. We have a tax savings toolkit that anybody can just download. And within the toolkit, we have a, what do we call it? We have a tax opportunity finder that people can utilize to see, how they're doing in terms of tax savings, what the risks might be, and also what are some areas of improvement that maybe they can, they can work on with the tax person. KeystoneCPA.com is the best place. And for anyone, who wants to get daily tax tip, I can mostly be found on Instagram as Amanda Han CPA.
And I'm sometimes in the background of Amanda Han CPA.
She's like my backup dancer for the social media stuff.
I love it. Well, thank you guys so much. It's been such a pleasure chatting with the both of you. I'm very excited for that next book to come out. So now that tax season is over, I know you're going to start writing content. Thank you so much again. Really appreciate it. And enjoy the rest of the year tax-free.
Yes,
thanks, Marta. Thanks for having us.
Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.